Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs. Hello and welcome to the Advisor Upside podcast powered by ETF.com. I'm your host, Jeff Benjamin, Wealth Management Editor here at ETF.com, and today we're talking with Bob Dahl, Chief Investment Officer at Crossmark Global Investments. Hey, Bob, thanks for being here.
My privilege.
All right. Well, we're going to get right into this. I know you're famous for your predictions and your outlooks, and you don't pull any punches usually when judging yourself on how you did on your popular predictions. So what I wanted to do with you is go down the list of your 10 predictions that you laid out at the start of the year, or maybe it was the end of last year, and see where we are now with 6.5 months left in the year. Let's just roll right into this. This is going to be a lot of fun, I think. Prediction 1. The U.S. economy experiences a mild recession as the unemployment rate rises above 4.5%. Well, right now, I don't think unemployment is that high, but we still got some time left in the year. What are your thoughts on this one?
Yeah, unemployment as we speak, Jeff, is 3.9%, up from the low of 3.5, and that's still a ways from 4.5. But perhaps more importantly, we are not in a recession. I am still of the view that by the end of the year, we will start a recession. Curious, as we speak, we're starting to see some bifurcation, particularly of the U.S. consumer, which of course is 2/3 of the U.S. economy. Low-end consumers are beginning to struggle. They're not as many of them have multiple jobs. Some of them are losing their jobs. Underneath the surface, it's not pervasive yet, but there's evidence that they're struggling, evidence that they're tapping their credit cards to live. Even some evidence, sadly, of rating 401ks to live. And we know that's not healthy and not sustainable. So I think at a minimum, we'll see an economic slowdown, frankly, from an economy, as you know, that's done very, very well for longer than most of us thought.
Right. Okay. Well, keep an eye on that recession coming, or at least a slowdown. Prediction 2, the 2% to 3% inflation ceiling of the 2010s becomes the 2 to 3% inflation floor of the 2020s. Now, what do you mean by this?
Yeah, what we mean is inflation will be higher than it was. I mean, we were treated to a decade of inordinately low inflation, lower than the long-term average. The long-term average inflation rate in the U.S. has a 3 handle, as you know, and we were largely at 2-ish in the last decade. And I'm not an economist, Jeff, as you know, but I talk to a bunch and read a bunch. And so-called structural economists argue that for demographic, technology, trade reasons, things lined up that last decade we had a very low inflation rate. Those same economists who might have argued for 2 are now saying more like 2 3/4. So allow me to round it to 3. So my view is we're stuck with a higher inflation rate, that the Fed is not going to get its wish of getting inflation back to 2, of course, unless we have a recession. Then it'll be there for a nanosecond or 2. And some might say, is there really that much difference between 2 and 3? The answer is, in most cases, no. But if it's 2 instead of 3, that has a big difference for where bond rates are, and a big difference from where the right PE ratio is for the stock market. So this is an important issue we're going to have to monitor for some time.
Okay. Prediction 3. I don't know if you're going to get this one, Bob. The Fed cuts rates. Well, I think you will get this one, actually. The Fed cuts rates fewer than 6 times suggested by the Fed's funds futures curve. I mean, that's kind of a low bar, isn't it? Fewer than 6 times.
It is now. It wasn't in December when we made it. The Fed fund futures curve at year end and for the month of December was at 6 times. And frankly, you might remember early January moved up to expectations of 7 times. So my
Mm-hmm.
goodness, we're not going to get this right. It's going in the wrong direction. And then, of course, things have unfolded in the months since the start of the year, where now the consensus is 2. It got down to 1. It's back up to 2. It'll bounce around. But the point is, I don't think inflation is going to fall enough for the Fed to cut rates anywhere near the consensus thought and hope for at the start of the year.
Okay, I want to ask you something specifically on that. How much does the presidential election factor into a potential rate cut before that election?
You know, less than most people think, in my view. I mean, I don't know members on the Fed. I've known some past ones, and I know people who talk regularly to the current ones. And you know, they try to stay out of, and I think reasonably successfully out of politics.
Mm-hmm.
Look, if Fed chairs cared about politics and the election and their jobs, they might not do what they have done. Sometimes that hasn't helped the incumbent president get reelected. So, long-winded answer to say, I think politics means less than most people fear.
Okay, that is something I wish was on a bumper sticker. Um,
Here.
Prediction 4, credit spreads widen as interest rates decline. Where are
So
we with this?
yeah, if the year ended now, we would get this one incorrect. Um, if you, as you recall, the end of October, the Fed basically said, "We're done. We're going to pivot. Next move will be to lower rates." Well, that was
Hmm.
a cue to stocks and bonds to take off. Stocks from the end of October to the end of March, 5 month period, up 28%. That's pretty amazing. And bonds did very well. And during that time frame, credit spreads narrowed, both for corporates and high yields. Our contention is, if I would argue, when the economy does weaken, we will see some credit spread widening, such that you're going to wish your bond portfolio has pretty high quality.
Okay. Prediction 5, earnings growth falls short of the double-digit percentage consensus expectation.
Coming into the year, the consensus was that earnings this calendar would be up 12%. And by the way, up 13% next year, 2025. The
Hmm.
US has never had 2 double-digit earnings years in a row unless we're recovering from a recession. So this would be the first time. That's part of why I am dubious. Needless to say, as first quarter earnings have come through well, some might say, well, Bob, now are you still concerned here? Yeah, I am. The back half of the year, the consensus is for mid-teens. Was fourth quarter 17% gain. I just don't see it.
Hmm.
And even if our economy doesn't weaken, they're tough numbers to achieve. So time will tell, but I think the double digit is pretty lofty.
Okay, so you feel like you got that one.
We're heading in the right direction, I guess is
Okay.
what I would say, Jeff.
All right. Uh, and this next one you got also, it might be perfectly. Prediction 6, stocks record a new time all-time high early in the year, but then experience a fade. So I think we got the high, don't we? Or are we right near it?
Yes, we've made multiple new all-time highs in the
Hmm.
first quarter of the year, and then in the last a bunch of weeks we had a sag. Is that the fade that I'm referencing here? Only time will tell. In recent days, we've had recovery from that low. As of this recording, not yet a new all-time high. Maybe we'll get there. So only time will tell. But the notion here is that there was a lot of momentum coming into 2024 for the stock market. It took the market higher for a lot of good reasons and plain old momentum. And my guess is it gets bumpier from here. Doesn't mean it has to be down a lot, but I just
Hmm.
think the early gains were the easy gains, and it gets tougher from there.
Okay. So that's a mark in the win column for you. Prediction 7, energy, financials, and consumer staples outperform utilities, healthcare, and real estate.
Yeah, we always have a sector prediction. It's always this basket beats that basket.
Hmm.
Um, We've not taken a tally since the end of the first quarter, but the end of the first quarter, we were about 850 basis points ahead on this prediction. As you know, energy and financials in particular have done well. Real estate has struggled. Healthcare has struggled. Utilities have performed better than most thought, but have only been a market performer. So, I mean, we got a bunch of months left to get this right or wrong, but boy, is this heading in the right direction. I would
Mm-hmm.
argue for energy and financials, Jeff, that those two sectors are very cheap on earnings and on cash flow. And whether we have continued good economy and up stock market, these can do well. And I think in a more defensive environment, they can also do well because of their cheapness.
Okay. This one here, it surprised me when I first saw it, and it surprises me again as I look at it again. The prediction eight, faith-based share of industry assets under management rises for the eighth year in a row. I would not have thought uh, when I first looked at this in December or January that it was on that kind of a run. What, first of all, is driving that? And then, I mean, you got momentum, so I guess it's a pretty safe bet, but I'd like to know what you think is driving that.
Well, we sure hope so. As you know, I work for Crossmark, which is a
Hmm.
faith-based money management firm. If you add all of us up, all the faith-based money managers, it's still a very small number. We
Hmm.
manage a sliver of the asset management business. But as the prediction comments, 7 up years in a row, we think this is the eighth. Reason? When you talk to individuals, financial advisors, and institutions, more and more of them are saying, hey, I think I want to line up my investments with my values. And that's what's driving this. For a lot of people, it's an education. Some say, I've never heard of this before. And when they do, often they're curious and they do a little digging, and some pass, but some say, yeah, I'm going to do this. So
Hmm.
that's why we're seeing this little tiny corner of the world grow at a faster pace.
Hmm. Okay, well, hopefully that keeps going. But yeah, it is a small percentage. By your chart here, the end of 2023, 0.266% of total industry assets,
Here, here.
faith-based market share. But in 2013, 0.137. So it's moving in the positive direction. Prediction seven. This is also kind of relates to, I think, something you said about politics earlier, and I don't know. I think this is interesting too. That I'm sorry, prediction nine. Geopolitical cross currents multiply but have little impact on markets. I just continue to find this fascinating. In the list of things that you have here, extreme polarization within U.S. on lots of issues, especially wars, two highly unpopular leaders running for president, Ukraine, Russia war, Middle East war, Iran nuclear threat, China Cold War, and global political uncertainty, 40% of countries, 41% of population, nearly 60% of global GDP, and nearly 80% of stock market capitalization experiencing national elections this year. That's mind-boggling to me. But why are the markets so separated from this?
Yeah, great question. I'm not sure I know all the reasons, but I just read recently that there will be 77 national elections across the globe this year, and only 17 have happened so far. So we got the
Hmm.
lion's share to go, of course, including us here in the United States. Um, why are geopolitical cross currents multiplying? There are a lot of reasons. My overall thesis, Jeff, is the United States has lost hegemony.
Hmm.
In years past, whether you thought it was a good thing or bad thing, the truth is the U.S. was undisputed leader. And it's like the bully on the playground. If the bully is on the playground, all the other people, you kind of behave themselves a little bit because they're worried what the bully might do. If there is nobody standing tall and we're all the same, which
Hmm.
is more the case now, everybody does what they want to do. And so you get these periodic maneuvers that might not have happened before. And that's why this list keeps getting longer.
Hmm.
Little impact on markets. Well, time will tell if that part is true, but so far, we would argue that's the case. I mean, there's a lot of hot spots around the world, and the stock market is blindly or cognizant with cognition, not paid a whole lot of attention. Look, if the Mideast war widens and the oil price gets involved and we get $100 oil, yeah, all bets are off. The markets will pay attention. But so far, it's a skirmish here. It's a problem there. Skirmish sounds like a small, unimportant word.
Uh-huh.
But if you live in those areas, it's bad news.
Right. Right. All right. Well, and then prediction 10. This one, again, a little bit of a surprise because you did this in December, remember? We're in May and it's things are getting closer because we're talking politics here. The White House, Senate, and House all switch parties in November. That means a Republican president, Republican Senate, and Democratic House of Representatives. What give me the thinking behind this?
Yeah, so somebody said you're just trying to be cute. No, there's a little science behind this. In 9 of the last 10 elections, Americans have booted the incumbents out of power. That kind of 9 out of 10 has not happened since Reconstruction, which is a long time ago. Look, Americans are of the mindset these days that whoever is in charge, I don't like him or her. I want to boot him out and bring the challenger in. That's the mood for the last bunch of years. And
Hmm.
we think that probably continues because, you look at the polls and you see, is America heading in the right direction? And, overwhelmingly, it's no. And so it must be the fault of the guy or gal who's in office. Let me kick him out and vote for the challenger. So that's what's behind all three switches. Time will
Hmm.
tell. As you know, the White House could go any direction. The Republicans do have an advantage in the Senate because they have far fewer seats to defend. Democrats have a lot of seats to defend. And the House, who knows? It's so close as we speak.
Okay. Um, all right. Now this is going to give you a chance to adjust anything you want to adjust at this point going forward. And we'll call it a mid-year outlook, which I think you do anyway. It's a little early, but we're going to cheat on this one. You have
Yeah. So,
anything that stands out?
here, well, first of all, as you know, we never change them during the year, and the end of the year comes and we get X right and 10 minus X wrong.
Uh-huh.
Is we never know which ones we're going to get right. If we did, we could make a bloody fortune. Um, Look, the election we won't know that one until December, and some of those other market related ones we won't know either. Truth is, Jeff, yeah, are there some that I feel better about than others in terms of probability of getting it right? Yeah, but are there any I wish I hadn't said? None at this point, believe it or not,
Mm.
which is pretty rare for this far into the year. So we're feeling pretty good about what's on the page. Look, if the economy doesn't slow, credit spreads won't widen. If the economy doesn't slow, we obviously won't get a recession and an unemployment rate above 4.5%. But most of the rest of these are heading in the right direction.
Okay. The one thing that everybody that does seem to be moving the markets one way or another is Fed policy. Do you see any rate cuts before the presidential election in November?
I think it's unlikely. But if I knew the answer to that question, I would know what data is going to come out. The Fed has said clearly, appropriately, they are data dependent. So to predict what the Fed's going to do means you know something about what the data is going to show, and I don't
Hmm.
think we know. Times are always uncertain, but I think they're more uncertain than usual. Earlier this week, Minneapolis President Neil Kashkari did an interview, and during the course of the short interview, he said, well, by the end of this year, the Fed may lower rates. And a little later on in the interview, he said, well, by the end of the year, the Fed may raise rates. So he's basically saying, I don't know where the data is going to go. Therefore, I really can't tell you. So I'm in that camp. If you knew the data, you'll know what they're doing. They're dependent on the data. And look, if the data slows a bunch and inflation really behaves itself, yeah, they'll cut before the election. If it doesn't happen, no, they won't. So my guess is there's a 50-50 chance. I know that's splitting the baby in half. That they cut before the election, maybe one more December before the end of the year. So I'm still in the camp of one or two.
Okay, I got a couple more for you here. Where do you see the biggest risk in the financial markets right now?
So I'm going to give you my three concerns, and you can pick them, or one of them, or all three of them.
Okay.
First concern is what we just talked about, it, the Fed and inflation. Inflation feels sticky to me. One bad month is not troublesome, but we've had three in a row, and therefore inflation is not under control. That bothers me. Number two, earnings. We already talked about it. Double-digit earnings 2 years in a row. How do you get there? We're a fairly mature economy. And thirdly, we haven't talked about this at all. Valuation levels. They're
Mm-hmm.
high. I could be forgiving of the earnings concern and the Fed and inflation concerns if stocks were selling at, call it 14 times earnings on a PE, but they're over 20 times. I've seen over PE in the 40 years I've been managing money, Jeff, three times. The height of the tech bubble, COVID, and now. And the first two outcomes were not very pretty. I
Mm-hmm.
hope this one's better.
Okay. And then where do you see the opportunities in these markets?
The opportunities, I think, given the uncertainties, and I'm not bearish, but I'm cautious as the hope is coming through, is I got to be really careful what stocks I own. I'm a large cap U.S. equity portfolio manager and have been for years, as you know, and so I'm focusing on companies that have high earnings predictability, high earnings persistence, and good, strong free cash flow, so that they have a chance of winning under a good environment, a mediocre environment, or a not so good environment. There are no stocks in my portfolio that I own because I think the PE is going up. If that happens, that's gravy.
Mm-hmm. Okay. And then finally, how would you advise someone to invest into this market? Are there any areas you would say, you might want to stay away from that, and this is a better place, or just dollar cost average across everything?
I'm a dollar cost averager all the time, but the higher the uncertainty, the higher the valuation, the more I preach that story. I guess the wrinkle I would put in, Jeff, is overseas. I'm not pounding the table on international stocks, but I am observing that far too many Americans, individuals, institutions have close to 100% of their assets here in the US. And that's been the exact right thing to do for the last 10 or 15 years. Stand up and
Mm-hmm.
take a bow, and then begin a little dollar cost averaging outside the US. Even in this rally we've seen recently, international is doing a little better than the US. So I want some international in people's portfolios.
Okay. We're going to leave it there. Really good stuff, Bob. Great catching up with you. And I want to make this a regular thing. Okay.
All the best, Jeff. Thank you.
All right, folks. Thanks for listening. I also want to thank our guest, Bob Dahl of Crossmark. And I want to remind you to check out ETF.com for all of our coverage on ETFs, portfolio management, and financial planning. If you have an idea for something we should be reporting on or talking about, let us know. I can be reached at jeff.benjamin@etf.com or find me on X under the handle @BenjiWriter. Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs.